Welcome back, and today we will be discussing Chapter 6 of the textbook, and in it we'll be talking about the various financial statements. We'll start with the Statement of Financial Position, otherwise known as the balance sheet. And the balance sheet accomplishes three important purposes. Number one, it summarizes economic resources and obligations. Number two, it aids in assessing the rate of return. And number three, it aids in assessing the riskiness of an entity. The balance sheet consists of permanent accounts with cumulative balances, and these are carried forward period to period and accumulate over the life of the firm. Next, we look at an overview of the classifications on the Statement of Financial Position or balance sheet. And these are, there are three primary classifications: assets, liabilities, and equity. We start with the assets, beginning with current assets, cash and all cash equivalents, short-term investments, accounts receivable, inventory, and prepaid expenses. The long-term investments follow, including property, plant, and equipment, intangible assets, and other assets. Note that these are listed in order of decreasing liquidity or ease of exchange. The liabilities include first the current liabilities and then the non-current liabilities. These are listed by due date, essentially. They include accounts payable, short-term notes payable, current maturities of long-term debt, accrued liabilities, unearned revenues, and non-current liabilities. Finally, we turn to the equity, which includes four items: contributed capital, retained earnings, accumulated and other comprehensive income, and non-controlling interest. One of the primary distinctions is current versus non-current. Current assets include resources that are expected to be converted into cash or to be consumed within the next year or within the operating cycle, whichever is longer. Current liabilities are obligations that are expected to be liquidated through the use of current assets or the creation of other current liabilities, in other words, being carried forward or rolled over. Next, we explain the presentation of current and non-current assets and liabilities on the Statement of Financial Position and name the common statement formats. There are two of these. Two common balance sheet formats include the account format, which lists assets on the left side, liabilities and stockholders' equity on the right side. And second, the report format, which lists liabilities and stockholder equity directly below assets on the same page in column form. In Learning Objective 4, we explain the statement of cash flows and classify common business activities into operating, investing, and financing cash flows. The statement of cash flow summarizes just that: cash flow, inflow and outflow for a firm over a period of time by operating, investing, and financing activities. Operating activities include the following six: cash receipts from customers, cash payments for the purchase of goods for resale or for use in production, cash payments to suppliers and employees, cash payments related to taxes, cash payments related to interest and dividend income, and cash payments of interest. Investing activities include cash receipts from collection of sale of loans made by the entity. Number two, cash receipts from the sale of debt and equity, securities, and other entities. Number three, cash receipts from the sale of productive assets, property, plant, and equipment. Number four, cash payments for loans made by the entity. Number five, cash for debt and equity accounts of other entities. Number six, cash payments for property, plant, and equipment and other productive assets. Financing activities include the following five: receipts for issuing equity to the owners, cash receipts for borrowing through bonds or notes, cash payments to repurchase equities from owners, buying stocks back, Number 4, cash payments for principal on debt. And number 5, cash payments for dividends. Learning topic number 5, or learning goal number 5, explain the direct and indirect formats of the statement of cash flows. Essentially, the statement of cash flows will vary only on the first, the operating activities. The investing and cash payment activities are treated alike under both. The direct method, the indirect method, also referred to as the reconciliation format, begins with net income from the income statement and reconciles it to the net cash generated from operating activities. The direct, also referred to as the income statement format, reports cash, receipts, and payments for all activities. As we said before, investing and financing are treated identically. Learning objective 6, the 4 primary financial statements and financial statement articulation are given at this point. The main financial statements, their proper given names are statement of net income and comprehensive income. Number 2, statement of financial position. Number 3, statement of stockholders' equity. And number 4, statement of cash flows. Our final set of objectives include explaining the purpose of the notes in the financial statements, including summary of significant accounting policies, subsequent events, and the related party transactions. Notes are an integral part of financial statements and provide additional information related to the line items presented. The notes expand financial information and include financial statements included in the financial statements and provide additional disclosures. The summary of significant accounting policies would be the first set. Details of methods the entity has used, for instance, treatments of inventory, etc. Subsequent events, significant events that occurred after the fiscal year ended but still in time for the report, and related party transactions, giving details on the entity's engagement with the owners, with management, and affiliated parties, including anything of significance that might influence the company. Last of all, we identify and describe the typical content of an annual report. Typically, this provides insight into its operating performance, financial position, and cash flows. It includes the following items: a letter to the shareholders from the CEO, management discussion and analysis, the management report, the auditor's report, a financial summary, financial statements, and the footnotes to the financial statements. The U.S. SEC determines the content of the annual report for publicly traded companies. And this concludes Chapter 6. We look forward to 2 more weeks, and we will be finishing this course. Hooray.